Ditch the complexity. Intuit Enterprise Suite delivers AI-native ERP that is intuitive and intelligent. Scale faster with advanced control, getting started in days, not months. Learn more at intuit.com/enterprise and get the power you need.
Introducing the all-new Adobe Acrobat Studio, now with AI-powered PDF spaces. Do more with PDFs than you ever thought possible. Need AI to turn 100 pages of market research into 5 insights with a click? Do that with Acrobat. Need templates for a sales proposal that'll close that deal? Do that with Acrobat. Need an AI specialist to tailor the tone of your market report to sound real smart in real time? Do that with the all-new Adobe Acrobat Studio. Learn more at adobe.com/do-that-with-Acrobat.
So, have you heard the story about the prescription plan with savings automatically built in? It's where a family of any size can feel confident the cost of their medication won't hold them back. Go to cmk.co/stories to learn how CVS Caremark helps members save just by being members. That's cmk.co/STORIES.
Bloomberg Audio Studios. Podcasts, radio, news.
This is a breaking news update from Bloomberg. Instant reaction and analysis from our 3,000 journalists and analysts around the world.
Looking at Netflix shares, they're continuing to move lower. This after the company reported results for the most recent quarter. Concerns about the guidance and boosting spending. The company saying even though they largely beat Wall Street estimates, they issued a cautious forecast for the months ahead, citing higher program spending. And then, of course, Carol, the cost of closing its deal with Warner Brothers Discovery.
Number of customers growing by almost 8% last year, topping 325 million subscribers. Let's get to our team who certainly follows it. And of course, our own Chris Palmeri, who's been following this company and the ins and outs of the pursuit of Warner Brothers Discovery. Chris, they're out there on the West Coast. Chris, you've known this company, you followed it. Investors not too impressed. They're worried about, I guess it seems like, the spend that's out there. But walk us through what really jumped out for you in their reporting.
Well, first of all, obviously, investors have been really concerned about the Warner Brothers bid. The stock has lost a lot of money since in October when it first came out that Netflix was interested in bidding. And you still see concern here. I mean, they said they've spent $60 million already on pursuing Warner Brothers. They're anticipating another $275 million in cost for that. They paused their share buybacks, which were considerable. They had $8 billion left in their buyback program, so they can conserve cash for the Warner Brothers bid. So if you're concerned about all this, there's certainly enough in there for that.
I'm just looking at some of the headlines from here, and given, Chris, the reaction from investors over the last few months as Netflix emerged as a bidder, it hasn't exactly been a positive one. What's the case for why Netflix actually needs these assets? Because this is a lot of money to spend, especially when investors are getting increasingly concerned about how much money the company's spending on content.
Well, they do in their letter to shareholders sort of cite the broader case that they're, no longer just competing against, HBO or Paramount Plus or whoever, that they're competing against YouTube, TikTok, Instagram, and that they really only have a still small share of overall TV viewing, about 9%. And by acquiring this great library and these facilities, Warner Brothers, they could really increase their production of stuff all around the world and get into some new business, more consumer products, more video games. And so that's their argument. HBO Max would give them the opportunity to offer different pricing plans. So somebody just wanted HBO programming, they could get that instead of Netflix. So those are the things they're talking about. I'm
going to play Netflix's accountant. How much? The content that they do get, they're going to get a lot of content, right? In one move.
If they get the deal.
If they get the deal.
Yeah, huge. It's a massive purchase in the $70 $80 billion range. There's numbers that came out today for Warner Brothers projections of what their studios and streaming business are going to do out 5 years, and it's a potentially huge boost. Batman, Bugs Bunny, everything you could imagine for Netflix to own. But they've also been investing in their own licensing deals. Huge deal just announced with Sony. Universal kicked in as well this month. And they're even licensing shows they noted from Paramount, 20 programs. So huge purchases of every variety.
Does Netflix, Chris, get these assets?
You mean, do they ultimately win Warner Brothers,
Yeah.
you think? Is that what you're saying?
Yeah. I know, that was quite a few chuckles.
Yeah. Well,
to be expected with a question like that, where you can't really see the
Hey,
future.
it's either yes or no, right?
But look, they're the
right.
favorable.
This is like, well, let's do the poly market prediction
Exactly.
here.
But they are the favorable. They are the favorite. No question about that. It's the board has said this is a better offer.
Well, they're the favorite from Warner Brothers' standpoint, for sure. But there's certainly a community of people that think, smart people, who think that Paramount's going to increase the offer or that this is going to fail from a regulatory standpoint. So to pick the winner from here is a real dicey proposition.
In terms of their subscriber numbers, where does that, this has been something investors have been concerned about, right? The sustainability of their growth. Based on what we got from the company, how does that, push back on that argument, or does it not?
It was pretty strong growth, 8% up to past 325 million. That was at year end. That was in line with what investors were forecasting. Stronger numbers were the sales growth, which any company would kill for double digit like that. They said where it's coming from. It's new members all around the world and price increases. They said they're going to increase prices again this year. They weren't specific, so it could be just in certain markets. Advertising business is growing. We all wondered how big a deal that was going to be. They said it was $1.5 billion last year. That's only about 3% of their overall revenue. But they said the number was going to double this year. So that part of it's growing. So as long as they can keep the prices climbing and the subscribers growing and the ad sales coming, they're going to see that revenue growth.
I just want to, especially for those people who are listening on radio, Netflix shares are down about 4.5%. They've been as low as a 5% decline here in the aftermarket. This is after the company plans to boost spending on programs in 2026, crimping profits at the massive streaming company.
Hey, Chris, before we let you go, pricing power that the company has. You mentioned price increases that we could see. How much pricing power does Netflix have in the U.S.? Like, there's no shortage of places to go for content, but Netflix, they're kind of the OG.
Mm-hmm.
Right. Well, I think the big story of last year really was that everybody raised prices and we didn't see huge defections of subscribers. And it's certainly getting to the point where, it's getting very pricey. Netflix has kind of been like the video utility. That's the one you can't cancel. It's got just about the lowest churn rate of subscriber cancellations of any of the big ones. So how long can it continue to do that? And maybe they would say if we have Warner Brothers, it's going to be a long time.
All right, Chris, thank you so much. Really appreciate it. Chris Palmeri, senior editor and entertainment team leader here at Bloomberg News out there in our bureau in Los Angeles. We're going to stay on Netflix, though.
Yeah, let's bring in Eric Clark. He's chief investment officer of the RIA Accuvest Global Advisors, about $1.2 billion in assets under management. Portfolio manager, too, of the Alpha Brands Logo ETF. He covers about 200 consumer stocks, including Netflix. It's the 11th biggest holding in the Logo ETF. Eric joins us from San Diego, which I understand it's like 69 degrees there. It's not like here, Eric, where the high today was 21 degrees. So
don't rub it in.
Yeah, I don't even know why you guys watch Netflix in San Diego. You just should be playing outside all the time. A decline of 4% after hours right now. Are you buying more Netflix?
I will buy more Netflix tomorrow. Absolutely.
Because...
And it's 75 here, by the way.
Oh, my bad.
Thanks very much for that. We're done with this interview. All right. So why are you going to be buying tomorrow?
Well, bigger picture, nothing's really changed with the business. It's just that people have left Netflix stock because of the Warner Brothers, the time that it takes to get a deal done like this. So people just say, I just don't want to have my money tied up in something that's going to be a little more uncertain than maybe, quote, dead money. That's the opportunity. So the stock's down over 30%. And business is still doing really well. And at this point where the stock is now, I don't even think it matters what the outcome of the Warner Brothers deal is. You're just getting the stock at a great price here. So you just have to be patient. That's all.
Are you saying that the Warner Brothers Discovery deal will happen? Netflix will get that?
That one is a little tough because there are the unknowns of the regulatory part. I think generally speaking, I agree with the concept that Netflix really is competing with all of our time, not just, other streamers or cable. It's YouTube and TikTok and Instagram, et cetera. But within the streaming, within the quote, kind of core cable TV viewing, they obviously are the dominant one. It's just, there's much more than just streaming, and there's room for every brand here. Netflix is the first place that people generally start. That gives them that pricing power. And then we bolt on the Paramount for the Landman and, Mayor of Kingstown, et cetera, and HBO Max, et cetera. But, the assets in Warner are so powerful and they are in the best hands with Netflix. It's impossible to know about the regulatory stuff.
But Eric, what if Netflix doesn't get Warner Brothers? Do you still like Netflix going forward, or do you think then this would be a big loss? We've done some reporting. I think we've had some stories that say this is going to help shape Hollywood, for years to come. Whoever gets this property. So I'm just curious, if they don't get it, Netflix does not get it, then what?
Well, I think they're just going to go back to the same playbook that has, driven 17% annual subscriber growth for the last decade. I mean, nobody can compete with them on the content spend. So they're just going to go back to doing the spending. Maybe they do some tuck-in acquisitions. It's hard to know, but you have to give management the benefit of the doubt. They've done, generally speaking, a pretty amazing job building this brand. And so you have to assume that they're going to continue making solid decisions, and you're getting a stock that's 30% off the highs with strong free cash flow. I know they will continue to grow margins. They will continue to grow subscriber growth. The ad tier is growing like a weed. So there's just a lot to like here. So I love this thing on a dip.
I'm looking at the 10 most watched movies from the second half of 2025, Carol. K-pop Demon Hunters, Happy Gilmore 2, Frankenstein, My Oxford. I did not see one of these.
I know. I was just thinking.
Movies.
The Woman in Cabin 10, A House of Dynamite.
Those are movies, not shows.
Oh, okay.
And even the top 10 shows, didn't see a single one of them. Wednesday, Stranger Things 5, Untamed, Squid Game, Stranger Things. Eric, this is interesting. The way that people watch the different seasons of Stranger Things in the second half of the year in anticipation for season 5. In the second half of the year, different seasons of Stranger Things were 3 of the top 10 shows most watched on Netflix. So is that an issue for Netflix moving forward? That's it for Stranger Things.
No, I don't think so. They will continue to bring out other stuff. I mean, they're just so good at this concept. I mean, listen, if they get Warner, that's even better because there's so much more that they can do to refresh that entire library.
Oh, so you're saying like, okay, Happy Gilmore 2 was in there. So maybe like another version of a classic HBO show or another version of classic Warner Brothers movies. Is that what you're saying?
I think you get a bunch of creative people in a room and they take something, let's say Sopranos, for instance. What could we do to refresh Sopranos in the same theme? There's just so many things that they could potentially do.
Hard to see.
Again, because you need the budget and nobody else has the budget.
Does Paramount Skydance, if they get the assets, do they have the creatives? Do they have the budget to do with the catalog what you think Netflix could do?
I don't think that they can compete with Netflix. And remember, they're still going to have a metric ton of debt to deal with. So I look at this like a private equity owner. If I owned Warner and that was my baby, who would I love to be able to sell that library to that would put it in the best shape for the rest of time? And that's clearly Netflix. It is not Paramount Sky.
Okay.
All right. So top of mind on the call with analysts and investors, Eric, like what is it that, we need to be asking this company right now? Or is it just really all about their pursuit of Warner Brothers?
Well, I just think that there's obviously just a lot of noise, and there's a lot of assumptions. There's a lot of assumptions in a lot of industries like AI too. But I think if you widen the lens, nothing has changed. It's still an important part of people's consumption. It's still an absolute crazy good value at even at $25. I mean, I go out to dinner in San Diego and you get a drink and a half and it's $25. I can watch an unlimited amount of content on Netflix. So there's still a lot of value there. And, recurring revenue business, global in size and scope, reaching kids as well as my mom at 83, male, female. I mean, there's just a lot to love about a business like this. And I feel the same way about Spotify too. Similar business, slightly different category, but for the same reason. And Spotify's off 35% too.
What's interesting too, they talk about, we've already begun to launch video podcasts from our partnerships with Spotify, The Ringer, iHeartMedia, and Barstool Sports, and have just announced 2 new original podcasts with Pete Davidson, the comedian, and NFL legend Michael Irvin. So we talk too about just podcasts taking off, and now it's not just audio anymore, it's video. So is this a big opportunity for this company or just a nice side business?
No, I think it's a big opportunity. I don't know about you guys, but I can consume 5, 10 times more content when I can listen to it in the car and listen to it on a bike ride or whatever. It's not just about reading anymore. People want audiobooks, they want music, they want videos, they want podcasts. There's so much opportunity, and both of these brands have just a wild opportunity, long term, gathering subscribers and bolting on new opportunities that drive operating efficiencies, add AI to the mix in more engagement, better profitability. There's just a lot to like, and you don't often get a compounder on sale like both of these companies. So you should take advantage of it if you can look through some of the short-term, kind of noise.
Eric loves Netflix. Eric, always good to see you. Thanks for
great to see you.
Hanging out with us.
I got to come out here.
Yes, we will.
I think the studio is about 10 degrees.
We were out there last year, and it was actually kind of June gloom when we were out in San Diego.
Was it kind of June gloom?
It was, yeah. Netflix shares, let's stay on this. The company shares fell in the after hours as much as 5.1%. This after it forecast first quarter EPS below the average analyst estimate. The company also plans to pause its share buybacks in an effort to accumulate cash to fund the pending acquisition of Warner Brothers. I want to bring in Bloomberg Intelligence senior media analyst Geetha Ranganathan. She joins us from Princeton, New Jersey, where Bloomberg Intelligence headquarters are. Geetha, just your takeaway from this report. The outlook is a concern. Spending on content. Got to tell you, this is like an age-old story for Netflix, right? The concern about, you guys are spending way too much. We could have had this discussion a dozen years ago.
I know. And yes, content spending. So it was up about 7% in 2025. They're projecting about a 10% increase in content spend going into 2026. And then, of course, you have the costs related to the Warner Brothers deal. And I think it's not just the cost side, right? Yes, operating margin, the guidance of Tim looks a little bit light. It's below 32%. I think the street was looking for something like closer to 33%, but also the ad revenue, definitely not bad, but not gangbusters. So this is the very first time that they've actually reported advertising revenue. They said it was about $1.5 billion in 2025. They expect to double that going into 2026. Again, definitely not bad, given that this company made its foray into ads just a few years ago versus all of the other media giants. But again, not really a number to kind of get too thrilled about.
So that's not I was just going to ask, is that in line or below or above the expectations that you've been making of late? I mean, nice to get some new data from the company, especially when in recent quarters they're not doing the same sort of disclosures they have in the past.
No, absolutely. I mean, so really 2020, as we kind of zoom out and we just take a look at Netflix, so 2024 was all about subscriber growth, right? They had about 42 million new subscribers. 2025 was all about pricing, right? Huge price increases. Again, pretty stable subscriber growth. They obviously did add close to almost 25 million subscribers. But then 2026, as we kind of looked at 2026, here was like the big head scratcher, right? What is the big growth catalyst for this company going into 2026? And that's really where people were wondering whether, that's why they had to buy Warner. And of course, one of the big things that everybody was looking for was ad revenue. Again, it has gotten off to, I would say, an okay start, but slightly on the lower side than I think people were expecting. People were probably expecting something closer to about $2 to $2.5 billion in 2025. So definitely, I think, fell slightly lower than general expectations.
I always think about, Geetha, like what's the next markets or how much more is there out there? And in their company release, they talk about, we relish competition, work to earn more of our consumers' attention. And they say, despite our success over the years, our share of TV time remains below 10% in the major markets in which we operate. And then they said, for example, according to Nielsen, in December, our share of U.S. TV time reached an all-time high of 9%, up 0.5 points year over year. Yet linear TV still comprises over 40% of U.S. TV screen time. Is this just blowing smoke, or is it really that there is still a lot out there for either Netflix or Amazon or some others to still grab when it comes to screen time?
Oh, absolutely. There is still a lot more room for streaming to grow, and I think it absolutely will. So I think one of the big things that we've seen, especially towards the end of 2025 and going more into 2026, is that, most of the marquee sports properties are now moving to streaming. So obviously you have the big launch of ESPN, for the very first time in the history of television. All of the marquee sports are now available for people to watch on streaming. They don't have to subscribe to a pay TV bundle anymore. And I think that makes a huge difference. Consumer behavior is changing. It's changing rapidly. And so obviously there is a lot more room for a Netflix, for an Amazon, as you pointed out, but also equally for a YouTube to grow. Mm-hmm. And this is where you have this whole debate with AI, right? Because as AI comes in and kind of democratizes content creation, you have more and more user-generated content. Are people going to be spending more time on YouTube and less time with like premier platforms like a Netflix, like an HBO Max?
I've just seen so much junk.
Is obsessed with YouTube.
Yeah, but not with the AI junk.
No.
I mean, social feeds. Have you seen anything good? Geetha, I've seen nothing good, nothing creative. It's like the junkiest.
With AI, you're talking about? Oh, you're not talking YouTube.
No.
Oh, I was talking
like
YouTube.
I'm the junkiest junk you can find out there.
Not yet, Tim, but I think just give it about a year or two, and I think soon we're going to be seeing pretty high quality stuff come out. I mean, I know some of the industry experts have basically projected that another 2 to 2.5 years, you will see the first high quality, fully AI generated movie come out. So again, have to wait and watch, but definitely a possibility and definitely something Netflix is preparing for.
These days, it seems like AI agents are just about everywhere you turn, every field and every function. But without identity, you can't trust they'll serve your business instead of jeopardizing it. Fortunately, Okta helps you get identity right by securing your AI agents' identities, giving you a single layer of control, a single standard of trust. So whether an AI agent supports a single user or your entire enterprise, with Okta, you'll turn risk into opportunity. Secure every agent. Secure any agent. Okta secures AI.
We buy insurance for peace of mind, but every year millions of claims are denied. Not because people did anything wrong, but because their policies quietly excluded what happened. Insurers know every detail. Policyholders rarely do. That's why My Policy Advocate exists. For just 27 cents a day, their platform reads your policies and explains where you are vulnerable. They don't sell insurance, they deliver transparency. Before you trust your policy to protect you, let My Policy Advocate tell you what it really says. Go to mypolicyadvocate.com.
This podcast is brought to you by Wise, the smarter way to manage your money internationally. If you're getting a headache from juggling different currencies and different bank accounts in different countries, there's a better way to receive money in the currency you need without the slow transfer times or hidden fees. Meet Wise, the savvy way to handle your money internationally. Hold balances in up to 40 currencies with the mid-market exchange rate on every conversion, whether you're receiving payments from tenants abroad, earning as a digital nomad, or converting dividends from your international investments. The Wise multi-currency account is for you. Be smart. Get Wise. Download the Wise app today or visit wise.com. Terms and conditions apply.